On a single Wednesday morning in September 1992, the Bank of England bled billions of pounds in a matter of hours. The institution acting as the buyer of last resort was being systematically drained on the open market. The event represented a calculated, mathematical dismantling of a sovereign nation's currency. The architect of this siege was a hedge fund manager named George Soros. He had identified a structural flaw in the British economy and built a $10 billion position to exploit it. His target was the Bank of England itself, an institutional leviathan backed by the UK's foreign reserves. Soros didn't break any laws to pull this off. He simply realized the financial system was enforcing a delusion, and he used the central bank's own rulebook to siphon away its wealth. 2 years earlier, the UK joined the European Exchange Rate Mechanism, or ERM. The government agreed to peg the value of the British pound to the German Deutschmark, artificially locking the exchange rate within a narrow, stable band. But the underlying economies were totally misaligned. While Germany was raising interest rates to fight inflation after reunification, the UK was trapped in a brutal recession with soaring unemployment. The currency peg was completely detached from domestic reality. To keep the pound trading at that artificially high level against the mark, the UK government had to hold domestic interest rates around 10%. They were crushing their own citizens' mortgages just to maintain an international exchange rate. Prime Minister John Major and his cabinet refused to back down, publicly committing to defend the peg, viewing a devaluation as a political failure. By ignoring domestic economic realities to maintain a rigid international boundary, the institution created a massive, highly pressurized surface area, ripe for an exploit. The economic trilemma states a country cannot simultaneously maintain a fixed exchange rate, free capital movement, and an independent monetary policy. The UK chose to fix its exchange rate and allow free capital flow, effectively surrendering their monetary independence to Germany. Soros exploited this by borrowing massive amounts of UK bonds and dumping them for cash pounds, which he instantly converted into stable German marks. Under ERM rules, the bank would drain its own liquidity to defend the peg. On the morning of September 16th, the assault began in earnest. The Bank of England started buying £300 million at a time, but the sheer volume of sell orders flooding the trading floors easily overwhelmed them. By 10:30 a.m., the bank tried to make holding short positions mathematically painful. They hiked interest rates from 10 to 12%. The market ignored them and kept selling. A few hours later, Chancellor Norman Lamont authorized a desperate hike to 15%. Soros operated on reflexivity, believing markets are driven by a feedback loop between flawed perception and economic reality. Recognizing the 15% rate as a suicidal bluff, he leveraged his short position to $10 billion. By fiercely defending an economic impossibility, the British government inadvertently signaled its own terminal desperation to the market. Other hedge funds smelled blood and swarmed in to join the siege. At 7 p.m., the defense collapsed. Chancellor Lamont walked out of the Treasury and announced the UK was suspending its membership in the ERM. The artificial peg was broken. This chart shows what happened the moment the market took control. Free from government intervention, the value of the British pound dropped straight off a cliff, crashing 15% against the mark and 25% against the dollar. Because Soros had borrowed his pounds at the high pegged rate, he could now buy them back at this crashed price to repay his massive loans. He kept the difference. When the dust settled, George Soros walked away with $1 billion in profit from a single day of trading. This sovereign balance transferred to a private offshore ledger through flawless, ruthless arbitrage. Black Wednesday exposed a stark truth about modern finance. Central banks do not actually control economic reality. They only control the perception of it, and only for as long as the market believes them. September 1992 proved global macro investors had acquired enough leverage to dictate terms to G7 politicians. It established a cold calculus that still governs the markets today. When an institution's political narrative deviates too far from mathematical reality, there will always be an apex predator waiting in the dark to collect the difference.